Or are you just picking a company? That was kind of my curveball that I had to really start at ground zero.
You're gonna recommend the management team. CEO. who's making-
A very stressful environment. It was rough.
That's probably a B plus.
Probably not. And I am old. I went and I ran the Rock the Parkway half marathon this weekend. Anybody run it? Okay. I was all by myself. So, been preparing for 4 months for this thing, and I had a target race time. And I hit my target race time, so I used that as an excuse to go out way more than I normally would. And that was Saturday, and now it's Tuesday night, and I'm still feeling the effects. It's just awful. What happens to you as you age is just, it's a real tragedy. So, fortunately for you all, we have one of the easier modules that we're gonna have all semester long. This is 100% review. Takes us basically all the way back to the start of the semester. I think we spent the first 4 modules hitting that review material so that we could build on it leading into modules. The accounting started to get complex in module 5 through 10 were heavy accounting that called on us all as analysts to know how the accounting worked so we could make the adjustments, so we could use it as we saw fit for whatever our use case happens to be. Maybe your bank examiner, maybe your corporate finance, maybe your mergers and acquisitions, maybe your private equity. We all are operating from the stance as though we're an equity analyst, portfolio manager. So we make the adjustments primarily to reconcile accounting versus peer group, maybe versus historicals, just so that we can comprehend what's going on. And there's a lot of accounting that goes into that, and I've asked you all to be mindful of how that accounting affects your management team's bonuses. I heard you mention you had a manager pass away, so yeah, that can throw a curveball in your analysis for sure. So we're transitioning. After we got through module 10, we moved into module 11, where we're beginning the finance side of this class. This class is the intersection of accounting and finance. We're going to take that accounting, make our adjustments, and now we're going to try to calculate what a company's worth. And we're going to use some of the basic building blocks that I know you all have covered in your intro to finance class. I'm going to try to give you a little bit of a refresher, but these are cost of capital and valuation basics are just that. These are valuation basics. So we should be able to zip through this material pretty efficiently tonight. Happy to take questions. Let's start with how the rest of the semester unfolds so that you all can confirm you're on pace and ask any questions that you might need to ask. I posted the 3rd exam on our My Business course website today. It's open for the next 2 weeks. It'll close at midnight, 2 weeks from today. So we'll do the math. Today's the 11th, 11 plus 14. Midnight on the 25th. If I've done that math. Same format as the first 2 exams. First 2 exams met my expectations in terms of scoring, so I don't anticipate any curve will be necessary. Although I do split that curve, and I didn't look at it by class. This is a blended class, so we have FIN 419 mixed with FIN 5561. That's an undergrad class and a master's class. I look at those scores independently. Haven't done that yet, so there might be a curve on FIN 419 sometimes. And I, typically get feedback from the folks in 419 that this is one of the more challenging classes that they've taken, and I haven't ever asked the question directly, but always inferred that by the time you're in the master's program, you've just had maybe one or two instances to run across this material more than you would if you're in undergrad, and that level of familiarity really helps out a lot. And so if that meets your experience, let me know. Okay, so that's the exam. I heard Brian say that the rest of the class material is not tested, and that's spot on. This is the last lecture, the last material that will actually show up on an exam. Next week, the following week, and the following, we will cover modules 13 through 15, but only in brief. You do have homework on those modules. Should be just, rinse and repeat, take it many times as you need to get the points, but it's not tested. Yeah, the idea there being that for the rest of the semester, I really want to give you all the opportunity to turn this class into a workshop so that you have plenty of time to get that research paper done. So that'll give us about 3-4 weeks. And there is a oral presentation that goes along with that. It's one of my favorite nights of the semester, because we do it Mad Money style, where everybody in class will get the opportunity to stand up and give 3 minutes, just an overview of all the work you've been doing on the semester. And I want you to hit those 4 M's. I categorize those research reports into management, give me an update on management; moat, give me an update on the competitive advantages that your company has; mispricing, why you think it's cheap or why not. That's the valuation component. And then lastly, mark. How is your company leaving a mark on the world? Finance brands that today is as ESG, but that can come in a lot of forms. I once did. This company just got bought out. It was CSBI Computer Services. They were a back office fulfillment, like regulatory and financial, and I think they're even dabbling in some crypto for banks. So if you own a bank and you need help with your back offices, you could hire CSBI and they do all the regulatory and compliance work for you. Well, their mark was culture, and they liked to tout how much their employees liked their culture, and they tracked that in terms of marriages. Like, and I think they're up to like 65. In the history of our firm, we've hooked up 65 marriages. And I'm like, okay, I guess your people like working there. If you need to get hitched, think about get a job with CSBI. I think they got bought by I want to say John Henry, but I'm not sure that's correct. At any rate, so that's the component. We'll do that in a couple weeks.
Is the presentation on the last week of class, or is that during like finals week?
It's on the last week of class, and then we won't meet finals week.
Okay.
But you have up until finals week to turn your research paper in.
Okay. Any particular day of that finals week?
Oh, you can turn it in till the last minute.
Oh, okay.
I need like 4 days to grade it. So usually the university gives the week of finals up till Friday, and then I gotta have it by that Friday, because then I'll spend all day Saturday and Sunday grading those things, and I'll need to get graded by Monday or Tuesday.
Okay.
And I did offer earlier in the semester, if anybody wants to take me up on it, it's really got to be by next week. A first draft reading of your research. I'll give you feedback on it if you want to take me up on it. Hardly ever get anybody to take me up on that, just because it's so intensive and most people put it off. But if you have a first draft that you're going to take a look at, I'll give you feedback and let you know how you get it.
What about our proxy reports? Will we get any feedback on those?
If you turned it in, you got the points.
Okay.
It's the proxy reports are a pass fail, and everybody gets 40 points.
Oh, okay.
So considering that, thank you for asking that question. Everybody gets 40 points on the proxy if you did it. And I've looked at them enough to know that everybody that's turned one in will get 40 points. Yes, a special person. So I want to confirm that everybody knows where they stand in the course, because you have access to all of your points. You have points for the proxy check. Everything else we've done in this course to date is on the My Business Course website. You should be able to see all of your points. You should have a good understanding of where you're at going into the 30.
Quick question, I'm looking at the syllabus now and it says recorded presentation, is that the same thing as doing a presentation in class, like a math thing, or is that a separate deal? It's like 5% of our grade or something like that.
It's 50 points, yeah.
Okay.
Yeah.
So that's like the thing in class.
That's the thing in class.
Okay, thank you.
Okay, I don't remember what was going on last semester. But I made it, the guy had a conflict. And I turned the whole assignment into a video. Like, all right, I can't be on ground that day, shoot a video, upload it to YouTube and send it to me. And that was how we did it last semester.
Thank you.
Seemed to work out okay.
I prefer the in person. I can plan it and stuff.
We got one yes, and
Yeah.
one no there. So, all right, let's go in person, and if that needs to change for whatever reason, I can call on. Okay, cost of capital and valuation basics, let's jump into this. Let me grab my notes. I don't have any notes. I'm winging it tonight. Let's see if I can remember what CAPM stands for without any notes. Okay, valuation basics. What we're really looking at here when we're trying to figure out what a company's worth. Well, let me put that to you. Let's simplify the company that we're working with. You're an entrepreneur, you got $100,000 in your pocket, you connect with Summit Business Brokerage Services here in town. You want to buy a business. Maybe it's a car wash. Business, car wash, laundromat. My daughter just got a job at Yogurtini, so I went down and I bought a $5 bucket of yogurt last night and OD'd on creme brulee, cheesecake, and lime tart, which is not a great combination for sleeping last night. But how do you put a value on that business?
You can do a DCF model.
With the DCF model, okay, yeah, you're way ahead of me. I was trying to dumb it down. What I want to know as anybody thinking about buying a business is, when do I get my money back? And the DCF model is a discounted cash flow model. So when I say you're way ahead of me, you've already thought about the accounting. You're going to simplify the accounting to actually keep track of the cash flow. When do I get my money back? I'm not concerned so much about the accounting as I am the cash flow coming back into my pocket. You got two streams of cash. You got cash going out the door and you got cash coming back in the door. Now, rule of thumb, what's a good payback period for a private investment? Anybody ever bought a business in this room by chance?
It just depends on what the business is, but the shorter the better.
Yeah, well, yeah, if you can get paid back in a year, that's terrific. As a rule of thumb, what I've always heard talking to just local entrepreneurs that are thinking about either expanding, buying a business, mergers and acquisitions, especially if it's private, because private deals are typically considered to be a little bit more risky. Public markets they tend to have a longer payback period. But for a private deal, 4 to 5 years is what you want to see. If you can get 4 years, that's great. Anything less than 4 years is fantastic. If it starts to go over 5 years a little bit, that's a riskier deal. So when you're answering that question for yourself, okay, how much is this business worth? First, you want to identify the cash flows. Then you want to figure out how long it's going to be until those cash flows pay you back. So you're forecasting the cash into the future, just like we did last week. That's module 11. And then in a discounted cash flow, that first word in that term is discounted. You have to bring those cash flows back to the present day so that you can compare it to the asking price. And if you properly discount those cash flows, you come to the conclusion that that business is worth 150,000 and they're asking 100,000 for it. That's a great deal. Tonight, we're going to talk a little bit about that basic structure, how we put it into an Excel spreadsheet, what we discount those cash flows at. That's a big one, and the basic structure of the lecture. Okay, so our authors lay that out for us in two different ways. First, they look at debt instruments, and we valued debt instruments earlier in the semester. I think it was module 8. So look at bonds and the present value of bonds, and it's the same basic transaction. What are the value of those future cash flows? You got the repayment of coupon, and you got interest when it comes to valuing a bond. Easy stuff. This fits into. All right, let's just pause and go look at that. Hey, Zoom crew, I'm checking in with you guys. I tried to share my screen. I just want to make sure that you all can see it. I think that you can see it, but
I can see it.
okay, terrific. Thank you. Okay, this fits into our whole semester. If you look at this class in one slide, it's right here. You can see that we started with a conceptual understanding of the competitive environment, Porter's 5 forces, SWOT analysis, so on and so forth in modules 1 and 2. Moved into those accounting adjustments that I talked about just a minute ago, which was really modules 3 through, call it 10. Last week was financial forecasting, module 11. And then for the next 3 weeks, we're going to be looking at some of those valuation basics. That's tonight. But then discounted cash flow is module 14. And then some of the price to book, price to equity, price to cash flow ratios that you see right on the front page of that research. When you pull up the template that I've given everybody in this class to kind of use and model your valuation off of, middle right-hand section, left-hand section is price to book ratios, price to cash flow ratios, return on equity. We want to look at those ratios, compare them to where a company's traded at historically and where their peers are traded. So we'll use this information to value the company, and we'll apply a time value of money. That's slide already do in my comment on slide 7. Okay, I want to pause here and get everybody on the same page with regard to the basic structure of what we're going to do next. We're going to lay out the cash flows in a simple Excel spreadsheet. So in this, I think in this example, we're looking at a debt instrument. So we have a coupon rate, we have a face value, and we have the market rate of interest. Easy stuff. At the end of the first year, we have interest earned at $90. Second year, $90, third year, $90, and we're going to discount the $1,000 face value or principal value that we receive at the end of the term back to present value at $975. So our authors start with debt because, fingers crossed, that's familiar to everybody, and this is a pretty simple example. Now we're going to take that and we're going to add in a little bit of complexity, but not much. We can do the same thing with equity. If we're looking at equity, what's the corollary? If the bond cash flows are interest, what's the corollary for a stock like Apple or Campbell Soup? They don't give you bond payments on a quarterly basis. They give you, somebody said it, dividends. So we can do the exact same thing. We got dividend payments in period 1, 2, 3, and then at some point we're going to get our cash back. which means that we're gonna assume we've sold the stock, and we can value it using an identical framework. Let's look at that framework. Okay. Inside of that framework, we're going to discount the cash flows using a cost of capital. And that cost of capital is identified based on opportunity cost. So in that business example that I used, say we're buying a car wash or a dry cleaners, and you're getting ready to write the check for that business. How do you discount the cash flows? If you're using a discounted cash flow model or just a simple dividend discount model, you've identified the cash flows, you think you got a 3 to 4 year payback period. What are you going to use as a discount?
Treated as cost of.
Whatever the cost of capital is, and I'm asking, it's your money. Use whatever the heck you want as a discount. Now, I'm gonna walk you through what modern portfolio theory tells you that we ought to be using for a stock, and there's a differentiation we'll make between systematic and unsystematic risk, and we'll tie that back to the market. But the point I'm trying to make is, when it's your money, you can use whatever discount rate is acceptable for you to take on those cash flows. And one of the primary ways that you all, any investor, any entrepreneur, any business person thinking about making an investment should determine that interest rate is based on opportunity cost. What's your next best option? If you can walk down to the bank and put your money in an FDIC insured savings account that's paying 5%, which it nearly is today, well, then you'd never buy any business and discount those cash flows at less than 5. So it's got to be something bigger than 5. Now, how much? Well, that's still going to be based on your opportunity cost. What are the better options out there for you? And are they safer in your estimation, or are they riskier in your estimation? That's where the real heart of this class comes in, because now you're identifying those cash flows. And if you have a high degree of certainty that those cash flows are going to come in every quarter on the first when you forecast them, then you might be willing to take on a higher degree of risk. If this is a rental property, for example, and it's 100% occupied, and 100% of those tenants have signed 10-year leases, and they're all grade A caliber tenants, those are pretty safe cash flows. You can probably discount that at something north of 5, because that's what you get in the bank, but you probably don't have to go to 10 or 12. Probably discount those at 6 or 7. So with that framework, we can look back to the history of finance and modern portfolio theory and recognize some ties or some corollaries to how the academics have done this. And the academics have recognized two different types of risk. If we think about investments inside of the context of what we call a diversified portfolio, well, Harry Markowitz, back in the late 60s, I think, might have been earlier than that, I don't remember the time frame, but I know it was attributable to Harry Markowitz. He did the math on this and identified a market portfolio as the primary risk factor, because all of what we call the idiosyncratic or asymptomatic risk can be diversified away. So anything that's specific to your CEO dying, or product failure, or inventory obsolescence, that's all idiosyncratic risk. That can be diversified away. So if we have a diversified portfolio, the primary indicator of how much risk that we're taking on is really our market exposure. And we can measure market exposure with something that we call beta, which is going to take us to the CAPM pricing model right here. This is the basics of how we're going to calculate the equity cost of capital. So I'm hoping again that this formula will look familiar to everyone in the room. Memorize it. If you ever sit for your CFA exam or just coming out of the block school, you should have memorized the time value of money equation. You should have memorized the capital asset pricing model. And there might be 2 or 3 others, but I can't even think of them off the top of my head. But this is one. You come out of a master's in business degree, especially a finance degree, It's just one of those formulas you kind of have to know. So hopefully, by way of review, what we're calculating here is the ROE, and you see that notated a lot of different ways depending on the textbook, but it's the cost of equity capital is going to be set equal to the risk-free rate. What's the risk-free rate? Treasury rates, yes. What time period? Is that the 30-day treasury T-bill? Is it 1 year, 3 year, 5 year?
5 years.
Could be 5 year. The answer to that question is it depends. I typically use a 10-year number because I'm trying to match to the holding period. So if it's an equity investment, especially, you're going to look at a stocks correlation to the market. I like to look at a stocks correlation to the market over a full market cycle. That gives me the best representation of what to expect in the future, because correlations are going to differ in bull markets, correlations are going to differ in bear markets. So if you look at it over a full market cycle, you're going to have a better representation. How long is it full markets? Economic expansion, economic recession, bull market, bear market.
They estimate like 10 years. around 10 years.
Yeah, I mean, maybe you call COVID a bear market, but it only lasted 2.5 months. And that's not even enough time for the effect of COVID to seep its way into quarterly financial reporting for a lot of institutions. So if you don't count COVID as a recession/bear market, you got to go all the way back to 2008. So I think of that 7 to 10 year period as being ideal for identifying that risk-free rate. So the risk-free rate, that's our opportunity cost, just like the savings account I mentioned a moment ago. Then you have, you're going to add to the risk-free rate a measure of beta. Beta is the correlation of a stock's price movement to the market's price movement, again, over what period of time. So I like to use a full market cycle. Our authors say 3 to 5 years. So just know that, again, this whole class is more art than science. But if you get asked on the test, because our authors wrote the book and because they wrote the support materials, say 3 to 5 years. Don't say, well, Burns said 10, because you'll get it wrong. But that doesn't matter, because you're not going to convince me that I need to be using something shorter. I guess I just disagree with the authors there. Okay, so we're going to take this measure of beta and we're going to multiply it times something called the risk premium. Now, this risk premium is the return to the market less the risk-free rate. So typically, the market averages this RM number, this variable right here. If you look at what stocks have returned, the time period is going to be very dependent there over the last 100 years, depending on where you pick your start and where you pick your ending point. Stocks have averaged between 9 and 11%. I usually plug in 10. The risk-free rate today is 5, so 10 minus 5 would be a risk premium of 5%. And our authors note here that typically fluctuates between 4 and 8, so we're right in the sweet spot. Okay, if you do sit for the CFA exam, they require you to know at length the failings of this model. Anything jump out at you by way of failings? It's not necessarily recognizable if you just look at the formula, but if you're familiar with the way the literature has developed and the way that the research. Academics, primarily Eugene Fama and Ken French out of the University of Chicago, they were some of the first, there's been several, to identify that the implicit and primary assumption of CAPM, that your risk varies with this single factor, can be easily disproven because there are factors. I'll list the 3 that won Ken French and Eugene Fama the Nobel Prize were size, growth versus value, which I think they called, they just called value, and quality. So what we know through careful study of the markets is that smaller stocks outpace larger stocks. Because everybody wants to buy Microsoft in 1982, everybody wants to buy Facebook in 2006, everybody wants to buy Apple in 1988, everybody wants to buy Berkshire Hathaway in 1965. But good luck picking out the next one of those if I give you a list of 1,000 small stocks today, because you're going to look at that list and you're not going to recognize any of them. But what we've come to understand through research is that if you just buy the whole list of smaller stocks and ever so subtly and tactically tilt your portfolio towards smaller caps, you can earn what academics call a risk premium. So what we take from that is that beta is not the primary determinant of your risk or your return. There are other factors that would appear to be a free lunch, small cap being one, value being another one. If you ever so tactically and subtly tilt your portfolio towards cheaper stocks, those have a tendency to win over time. Same way with quality is measured by a variety of different indicators. Earlier in this, so we looked at return on net assets and return on operating profit. Both of those would be a measure of quality. Okay, then all those. Okay. Put a pin in that comment. I want to come back to it. So size, value, quality premiums. But I want to walk through this little example here first, just to make sure everybody has a good understanding of how we plug the variables into this CAPM equation, because you're going to be asked to do that. You need to understand what the beta is for your company. So if you haven't looked that up already, look it up. You'll be able to find that on Morningstar or Yahoo or lots of different places to quote that. And then just cite it in your research report what you happen to be using it. So you can shortcut this analysis here, but you should still know how to do it. It'll be on the homework, it'll be on the exams. I think we're looking at next era. So the next era stock, we're calculating the CAPM for next era. And the risk-free rate in this example is 2.034. That's the 10-year treasury. Okay, great. They're using the 10-year there. So our authors happen to be in alignment with our authors there. Beta is 0.16. Again, you can find that on Yahoo Finance. And then they're assuming that the market risk premium is 5%. So then it's just a plug and chug. Risk-free rate plus 0.16 times 5%. Put all those into your equation, and the cost of equity capital is 2.834. What do you think of that? Tell you what I think of it. That's low. 2.834 is, that's kind of your hurdle rate. If you use this is how you need to think of this. This is how you contextualize this. If you are 100% accurate in your forecast, you have a crystal ball. Every number that you put in your spreadsheet for 2023, 24, 25, 26, all those numbers come true. Those cash flows are 100% certain. If this is your cost of capital and you pay a fair value for that company, well, as those cash flows realize your forecast, this is going to be your rate of return. I don't get very excited about it. A 2.834% rate of return doesn't get me very excited. Now, in this example, we're comparing that to a risk-free rate of 2%. So it's a little bit better, but it's not very much better. Why? So that's the mechanics of the math, because the beta is so low. So in theory, investors are willing to pay a little bit more or accept a little bit less or require a rate of return that's lower because this beta is lower. And if you are investing in a diversified portfolio, this stock is very attractive because a beta of 0.16 means it has a very low correlation to the markets. So this is the old adage, don't put all your eggs in one basket. This correlation, because it's not tied to the market, means that it will have some very favorable and beneficial offsetting effects. Okay, this is another one of the shortcomings of CAPM. As an investor, in order to get those offsetting effects, in order to reap the benefits of a diversified portfolio, you don't really care what the beta was. What you care about is what the beta is going to be. So now, as a user of CAPM in your modeling, you have to ask yourself, well, is a historical beta of 0.16 an accurate representation of what I can expect in the future? Okay, well, if this is a utility company and they have been, reaping the benefits of consistent electricity bills for the last 10 years, and that business is likely to persist in the future, then maybe the answer to that question is yes. If this is a utility company who has been reaping the benefits of those consistent cash flows for the last 10 years, but just pivoted and invested in a wind farm that's going to offer non-peak power to states outside of its typical zone, the fundamental aspects of that business have changed significantly. And on account, you should expect the variability of those cash flows to change significantly in the future. Okay, this is the art. So now it becomes your job as the analyst to say, well, I recognize the historical beta was 0.16, but there's no way that's going to hold in the future. So I need to come up with a different estimate. Maybe you're looking at peers. Maybe you're just kind of eyeballing it. So Buffett, one of my favorite investors, he takes CAPM and he just throws it out. His rule of thumb is the 10-year treasury plus 3%. That's what he uses. That's my discount rate. 10-year treasury plus 3%, because the rest of it just gets too complicated, because you got to second guess things like beta. So, and then if you follow the way Buffett invests, that's his discount rate, 10-year treasury plus 3%. And when he computes his discounted cash flow and brings everything back to time zero, he applies a margin of safety. So if his analysis using that discount rate says something's worth $100, he says, okay, I'm going to apply a margin of safety and I'll pay 80. I can't get it for 80, I'll just wait. Okay, now looping back around to small cap, value, quality. There have been other factors identified by academic research in the last 10 years that include low volatility accounts that are safer. That's low beta, low vol. Other factors have actually been shown with some statistical rigor to offer those sources of return. This is how we identify those with a multi-factor model. This is beyond the scope of this class, other than for you all just to know that multi-factor models exist. And this would be the nomenclature for how you would identify the returns that drive your cost of equity. So you have the same risk-free component, but then you're adding multiple betas. So each of these betas is what academics call a factor. So the first factor in any multi-factor model typically harkens all the way back to Markowitz's original research, and we will use the correlation to the market. But then we'll add the correlation to some other measure of market returns, like value or small cap or quality and so on and so forth. Early on in my career, I worked for a quant shop, and we would calculate these multi-factor models. And we had a 55-factor model. And we had identified correlations to a dozen different value components and momentum components, price momentum, earnings momentum. And then we had that 55-factor model that we would apply and test discretely across 35 industries. Because each of those components is going to have a different effect if you back test it against banks or industrials or consumer durables or name your industry. These betas, which we call payoffs, would vary over time. So that's an area of finance that is one of the absolute fastest growing. I find it one of the most fascinating. You also need to be a real brainiac to dip your toe in the water if you want to go make a real profession out of that, because you are now competing against the brightest minds, not even majoring in finance. You're competing against the brightest minds majoring in computer science and engineering coming out of MIT and Caltech. So these are the same minds that are, creating ChatGPT now, because they know through some of that programming and through the co-location and fiber optics and everything that goes into the high frequency trading these days, they can actually get an edge on the markets. And if through accurate modeling and computer engineering, you can get an edge on the markets, well, you can make a lot of money really fast. And Goldman Sachs, BlackRock, some of these larger brokerage firms, they pay very, very well to make sure that they're modeling the latest and greatest. And a big part of that research field right now is in new databases. How can we get an information advantage utilizing some of these new data streams? So this story is old. I think that they call it information decay. Some of these new data streams now, they work for a bit of time, but then as soon as the rest of Wall Street catches on, the information decays, and the value of that information is not what it once was. So it used to be that you could take a Google Earth image and count all of the cars in Walmart's parking using Google Earth. And somebody figured out that that was a factor. Okay, well, now you could calculate Walmart's beta of cars in the parking lot and regress that against their future earnings announcements, and come to find out, surprise, surprise, the more cars they had in their parking lot, the higher degree that you could forecast their earnings. And if you knew what their earnings were going to be, you could front run that trade. You could either buy or sell in advance. And that worked very, very well for a while for hedge funds that used it. And then other hedge funds caught on, and the information value of that kind of decayed. So you can't make money doing that anymore because too many people know about it. I thought it was a pretty interesting use case for how to jump on top of, it's public information. Everybody has it. Just have to know where to go to get it. Okay, quick note about debt capital. Now we're going to switch and we're going to talk about weighted average cost of capital. So if we're just looking at bonds, we're going to use the cost of debt capital. How much did it cost for us to borrow that money? And we're going to use that borrowing rate to discount those cash flows back to fund zero. If we're looking at equities, then we're going to use the cost of equity capital. Now, we just identified equity cash flows. The corollary to bonds would be dividends. So for a dividend discount model, we would use a cost of equity. But for a discounted cash flow analysis, we're going to use a weighted average cost of those two things, because those are cash flows to the firm. They include a little bit of equity, a little bit of debt financing. That weighted average cost of capital calculation is first based on the cost of debt, and we need to be mindful that that cost of debt carries with it a tax advantage. So when we deduct the interest, that is an interest tax shield. So we're going to use this basic calculation up here where we denote the cost of debt, R sub D, as the pre-tax borrowing rate times 1 minus the tax rate. I believe that sounds very familiar. Let's plug that into an equation over here. If we use next era's data, we're going to take the cost of debt, which is 3.34%, which is calculated as the pre-tax borrowing rate. That might just be given in the 10K, or you could take a swag at it by looking at a company's interest cost and dividing it by the total debt outstanding. Nothing complex about that. So their cost of borrowing is 4.47. Multiply that times 1 minus their tax rate. Where do you get the tax? I'll give you a hint. It's the same place you get everything else. Yeah, it's always in the 10K. Everything we've been looking at all semester long, there's some table disclosing all the ins and outs of it in the back of the 10K file. Same way for the tax rate. You're going to get a breakdown. We looked at it a couple of weeks back. you're gonna get a breakdown of how all of the different foreign transactions and offsets adjust your corporate tax rate that typically starts at 35, and then you have all these offsets, and then you have a weighted average kind of tax rate that the company will report, and in this case, it's 25.2%. So throw all those numbers into that equation, and we have next era's cost of debt at 3.34%. We're gonna take that cost of debt and we're gonna put it into a weighted average cost of capital formula that looks just like this. The weighted average cost of capital is exactly what it sounds like. Average cost of capital. What are we gonna weight it by? Somebody's got to answer this one. We know our cost of debt is 3%. We know our cost of equity financing is 8%. Just gonna average those two things together. Call it.
Proportion of capital, debt and equity ratio.
Yeah, exactly. So if the company was 50%, you just look at the balance sheet to get this information. If it's 50% debt, 50% equity, then that would be a weighted average, of 50-50. It's usually not that way. And to add a complicating wrinkle to it, we want the intrinsic value of the company, the intrinsic value of the company debt. So we'll look to see what the market value of each of those is. So intrinsic value is theory. We're going to use market value. So this is the publicly traded quote for the equity and the publicly traded quote for the debt. Typically debt trades at about par, but that's not necessarily the case. So we need to be mindful of that when we're putting all those variables into that equation. So the percentage of company that is debt times the cost of debt, the percentage of company that is equity times the cost of equity. There's your weighted average formula, and throw all those numbers into that equation and we get a weighted average cost of capital for next era of 3%. I didn't look to see in our text what next era actually does, but with such a low cost of capital, I would assume it's a utility company or something similar. Okay, let's look at dividend discount model. If we're only dealing with dividends, this formula is going to take the shape of that bond model we looked at a few minutes ago. We reduce it down to the intrinsic value of the firm is equal to the dividend in period 1 plus the intrinsic value of the firm divided by 1 plus the cost of equity. Now, this is how it breaks down in practice. We're just taking all of those cash flow streams and discounting them back to times 0. So the dividend in year 1, the dividend in year 2, the dividend in year 3, exactly like a bond. It gets a little bit complicated when we try to figure out when we're going to sell this stuff. Now, this formula right here is what discounts the perpetuity value. So if we are trying to calculate the value of that annuity that we receive if we cash those dividend checks into perpetuity, this is exactly how we would do it. We would forecast the dividend out 2 or 3 years. Maybe we have a period of rising dividends for the next 2 or 3 years. At which point in time, we would say, okay, the dividend in period N equals that dividend discounted back to times 0 plus a perpetuity value, which is represented right here by this formula. You don't need to commit that one to memory, just star that page or flag it in your book so you can come back to it if it happens to be on the exam, but that's a pretty simple model. The advantage of a pretty simple model is it's easy to use. The disadvantage of a pretty simple model is most companies have some growth rate associated. And not very many companies have a $1.50 dividend forever. That dividend is going to grow a little bit. Companies go through ups and downs. The market grows at 9 to 10% on average. Most companies are going to have some growth rate associated with just kind of general progression of their business. How do we model that? Well, this variation of the dividend discount is called the Gordon growth model after Professor Gordon. I don't remember Professor Gordon's first name, but he gave us this nifty little equation right here. If we take that dividend and we divide by our cost of equity minus the growth rate, we're going to solve for that perpetuity value. We're going to solve for that intrinsic value for companies whose dividends are growing. So take Coca-Cola, Procter & Gamble, or IBM, any other blue chip, and assume their dividend's going to go by 2% a year. That's probably not way off. And now you have a reasonable valuation component for factoring in a company's growth. Now, these models that we're reviewing, we're not getting into a discounted cash flow model tonight. That's a little bit more sophisticated. And that's the model that I want all of you to use, if possible, for your research reports. But for some companies, a dividend model, even though it's simplistic, works very, very well. If you're modeling an old-fashioned bank, you're modeling some utility, if you're modeling just the more boring a company is, the more it probably lends itself to a dividend discount. The more sophisticated a company is, the more work you're going to have to do, probably in the discounted cash flow modeling, but then also in the relative multiple analysis. Maybe some of the comparables that you use, you might have to look at some transaction comparables. Which is one of the reasons why I ask everybody to select their company off the Morningstar's list, because they typically lend themselves to a simpler analysis. Okay. Okay, that's it. That's module 12. I'm a little early, but I'm going to end there tonight because this was the last of our testable material. I don't want to necessarily progress into module 13 tonight and start talking about stuff that's not going to be in the exam. We can cover that next time we get together. Got any questions for me about anything before we start tonight? Okay, thanks, gang. Appreciate it. Thanks, Zephyr.
Thank you.
It's not. Yeah, yeah, no, I was actually reading stuff and making bullets. But it's just exactly.
Yeah.